Investment banking. Investment banking should be unchained. May 3rd, 2017. I'm Gopalan Ramachandran, Ramach to my friends and to my associates. And my email is indoiowan@gmail.com and my Twitter @ramachgramach. This presentation reinforces the keenness of President Donald Trump to separate commercial banks from investment banks. The logic and the justification? Commercial banks take in deposits from households and then lend these deposits to borrowers. By contrast, investment banks neither take in deposits from households nor lend any of these deposits. America has perhaps undermined its economic recovery since 2009 by holding the legislative, regulatory, and popular views that commercial banks and investment banks do the same things. I may want to add the journalistic view as well. America will shortchange itself further and short sell its economy in the future by continuing to hold the view that commercial banks and investment banks do the same things. America needs to unshackle and unchain its investment banks. America needs to unshackle and unchain its investment banks. And why? Investment banks and commercial banks are in very different businesses. Commercial banks and investment banks should be separated from one another. Let's unshackle and unchain America's investment banks. Let's act on Gramm-Leach-Bliley Act of 1999, GLBA. Indo-Iowans learned and taught commercial banking, investment banking, securities, and asset management at the University of Iowa, Iowa City, Iowa, the United States of America. A very fine place to go to learn and go to teach. The Iowa Alumni Network includes lenders, insurers, asset managers, and investment bankers. Part 1 of the series on investment banking was published on April 18, 2017. Let me continue now with Part 2. Commercial banks and investment banks are in very different businesses. Therefore, commercial banks and investment banks have very different business, structural, and organizational risks. Therefore, commercial banks and investment banks need to be capitalized, managed, monitored, and regulated differently. Similarly, insurers and the insurance companies too need to be regulated differently, but we will discuss this in another presentation. Commercial banks pose an enormously bigger risk to the savings of households and to the American economy than investment banks do. The three principal risks, and the word principal means many things, very important, because commercial banks act as principals even though they work with the deposits of households. The three principal risks are liquidity risk, market risk, and credit risk. Investment banks, by contrast, eliminate risk, ameliorate risk, or modify these risks in order to serve households and the American economy. Commercial banks are the sources of risk, they're exposed to risk. By contrast, investment banks manage these risks, eliminate them, and or modify them. Therefore, it's a misjudgment that commercial banks are regarded as less risky than investment banks. Worse, the business media, regulators, and Congress do not wish to know or to see the difference between commercial banks and investment banks. It's also a gross misjudgment that both commercial banks and investment banks are seen as banks. That's very important here. The fact is, commercial banks are indeed banks, And the other fact is, investment banks are securities firms, they are not banks. Let's say that again. Investment banks are securities firms, they are not banks at all. Investment banks do not make any decisions on what bonds, equities, asset backed securities, mortgage backed securities, and other derivatives their customers should buy, hold, and sell. And it's not a matter of convenience to regard commercial banks, also known as depository financial institutions, and investment banks, they don't take any deposits, do they, as economic equivalents. The inconvenient truth is, by regarding the two as economic equivalents, America is holding back both commercial banks and investment banks. By unchaining investment banks, America will unchain its commercial banks too. America's economic aspirations will be better served by unchaining commercial banking from investment banking and by unchaining investment banking from commercial banking. Let's consider now the flow of savings, because we need to establish the fact that commercial banks face a whole lot more risk as principals, and these risks are ultimately faced by depositors who have no control on how their monies are lent. That's very important. So, savings, especially of households, are taken to depository institutions as deposits. And why do depositors take their savings to depository institutions? Put it the other way, why do households take their savings to depository institutions? The answer: money does not make money. Money under a mattress and money in the wallet do not earn a dime. And that's the reason why households take their savings to depository institutions. And what happens now is this: the savings of households could go into one or more depository institutions by class. The first, commercial banks, the big commercial banks. The second, the local credit unions. The third, the savings banks. The fourth, the savings and loan associations. They have a choice, but all of them lend. And let's see why they do this. But more importantly, deposits flow into commercial banks, credit unions, savings banks, and savings and loan associations, the S&Ls. Consider now the characteristics of deposits and depository institutions. Depository institutions pay interest on deposits. Therefore, or put it the other way, so depository institutions need to lend the deposits to borrowers that will now pay interest on the principal the borrowers borrow. So depository institutions will have to become lending institutions in order to pay interest to the depositors. Consider now the flow of loans. Depository institutions will seek out borrowers to whom they will be giving loans. Why do depository institutions lend? Depository institutions need borrowers. Depository institutions lend because money does not make money. Money in a vault and money stored digitally do not earn a dime. So, depository institutions need borrowers. And I have four classes of borrowers there. In any case, the first one would be households. Households save and other households borrow. The second, very important, unincorporated firms, the mom and pop firms, the small local enterprises. They are unincorporated, but they too need to borrow money to grow. The third, the big corporations, the huge corporations. And finally, governments, which will include the federal government and the numerous local governments. And to each one of these four classes, depository institutions could make loans. They too have a choice. And what about the characteristics of deposits now in the context of the loans they make? Depository institutions need to repay the deposits on demand. But the moment a dime comes into a depository institution, the interest clock starts ticking. Therefore, the dime leaves the depository institution and goes into one or more of the four classes of borrowers. The deposits, by contrast, can be withdrawn by walking into the depository institutions. And who can withdraw this? The depositors, naturally. They can walk into a bank, they could swipe a magnetic card or a chip, they could write a check, or they could effect an online transaction. And now enter the first of the three risks, liquidity risk. Liquidity and liquidity risk is what we will discuss now. Remember, the moment a dime from a depositor comes into a depository institution, the interest clock starts ticking. The depository institution has to pay interest on those deposits. But the money itself is not there because it has to be lent to earn interest from borrowers. However, when the depositor walks in to withdraw money, loans made to borrowers may not be due for repayment. The dime that the depositor brought in is now with the borrower, and the borrower is not obligated to lend the dime. Depository institutions, therefore, need to remain liquid and need to have access to liquidity. They need to have access to liquidity. Very important. And the US Federal Reserve provides such liquidity. Very important. You need to have the US Federal Reserve provide these depository institutions such liquidity, because every dime that comes into the depository institution as a deposit goes out instantaneously into a borrower's account, who then uses it to build assets and to serve customers. So we now have to discuss default and credit risk, the second of the three sources of risk. So let's have the depository institution here, and borrowers may not repay loans when the loans are due for repayment. Depository institutions may not have the funds to return the deposits of their depositors, and that's a serious case, because this is now going to lead to a liquidity problem and therefore also lead to a default problem. Liquidity vanishes and the depository institution is left high and dry. And the serious problem here is depositors do not make the lending decisions. Depository institutions make all the decisions. The borrower, the term of the repayment period, the collateral brought in by the borrower, the down payment, if any, brought in by the borrower, and finally the interest rate on the loan that would be commensurate with the credit risk of the borrower. No decision in this panel is made by the depositor. Every decision is made by the lending bank, and it's very important here. Therefore, depositors trust the depository institutions a whole lot. There's trust that cements the relationship between depositors and depository institutions, but none of the decisions made by the depository institutions is amenable to any influence by the depositors. That's why commercial banking is also described as indirect finance. The depositor loses both identity and influence. It's indirect finance. Every decision is made by the lending bank. Finally, let's consider market risk and default, the last of the set of risks. Depository institutions have lent money to borrowers, loans, 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 and loans. And in the event the loans don't get repaid, there's default risk that the lending bank has to face. But we'll also consider why borrowers may not want to repay the loans. Default is an option. Default may also be a compulsion. But let's consider default as an option. When the collateral value is $100,000 and the loan to be repaid is $200,000, what would a struggling borrower do? perhaps let the collateral go, allow the bank to repossess it. But the point is, the bank has lost $100,000 and so have the depositors. The subprime crisis was triggered by a fall in the value of homes. And yet, we need to keep in mind that depositors do not make the decisions pertinent to lending. Depository institutions make all the decisions. Depositors have no control on liquidity risk, no control on collateral and market risk, and worse, depositors do not decide who borrows, which means that depositors depend on regulation. And let's put this all together as depositors have no control on default risk, because default is both an option and a compulsion which the borrower either exercises or is exposed to. Therefore, depository institutions have to face the music. They have to face default risk. America's regulations pertinent to depository institutions, and these are the commercial banks, and the support systems thereof, do two things: enable depositors to cede control over their own deposits, and allow them the peace and calm, allow themselves the peace and the calm with the belief that liquidity risk, market risk, and default risk are eliminated, mitigated, and or managed effectively. There's belief and there's trust, and backing such belief and trust, we have America's regulations. By contrast, investors make all the decisions on what bonds, what equities, asset-backed securities, mortgage-backed securities, mutual funds, and other derivatives to buy, hold, and sell. They make these decisions as principals. Investors in the context of investment banking are the principals. They retain the principal risk, which means investors do not cede control over their own funds. Investors know the liquidity risk, they know the market risk, and they know the default risk they're exposed to. They use their own judgment because they are the principals. Investment banks do not make any promises to mitigate these risks. Investment banks are not obligated to mitigate these risks. We will discuss bonds, equities, asset-backed securities, mortgage-backed securities, mutual funds, and other derivatives soon. But we need to keep in mind that commercial banks are the sources of risk to which depositors are exposed to. Commercial banks act as principals, but investment banks work as agents of their own customers. Customers do not cede control over their own funds, nor do they cede control over the risks. Let's also do a bit of rumination here. Glass-Steagall Act of 1933 has served America effectively. GLBA came much later in 1999. America has accomplished a whole lot in those 66 years. 66 great years between 1933 and 1999. Consider the following. America has rebuilt itself after the Great Depression, won World War II, rebuilt Europe, built its own infrastructure. They say America was built by bonds. Don't forget that. America was built by bonds. America made its municipal securities the envy of the world, thereby giving its cities and counties and states financial autonomy. The Glass-Steagall Act enabled President Richard Nixon to kill the gold standard. America built NASDAQ. America built the Depository Trust and Clearing Corporation. America gave the world and itself Silicon Valley and venture capital. Glass-Steagall Act has served America admirably well. GLBA came much later in 1999. Thank you for your time. I'm Gopalan Ramachandran, Ramach. My email indoiowan@gmail.com and my Twitter @RamachGramach. End of part 2.